Okay, Mike. Go ahead, Mike.
Good morning. Today is August 14th, 2025. This is the Budget, Capital, and Personnel Committee of Tompkins County. And I'm Mike Lane, the chair. Joining us in the chambers are Randy Brown and Lee Shurtleff, Deborah Dawson, and Shauna Black. And on the screen, we have another legislator, Ann Corman, is joining us. I think I caught them all. Changes to the agenda.
Mike, where's Veronica? Is she away or?
We're expecting her, I think.
Okay.
We haven't heard anything.
Thank you.
Changes to the agenda. I simply want to move the audit report up before any of the reports today. Any other changes that we're aware of? Do we have any public comment this morning? Not seeing any. Can we take the minutes of July 10th? Someone want to move them? Shauna's moved them. Deborah seconded them. Discussion, changes? Ready to vote? Those in favor? Any opposed? That's unanimous. For my report, I will simply say that we are going to have an executive session later in the meeting to discuss labor negotiations. And personally, I have a hard stop at 11 because I have to be in Lansing by 11:30. So if we're still going at that point, I will turn it over to our very distinguished vice chair, Deborah Dawson.
I've never been called distinguished before, Mike.
Our esteemed colleague.
Not that either. Keep trying.
Okay, I'm going to turn it over to Daryl at this point. Daryl, do you want to introduce our auditors?
Good morning. Thank you, Mike.
A little closer to the mic. There you go.
Thank you. Good morning. I'm happy to introduce Dwayne and Conrad from Insero. They did our audit this year and have for many years. Come on up.
Feel free to come on up. Familiar faces. Nice to see both of you.
Good morning and thank you. And thank you for a few minutes to review the results of the audit with you. The reports that you received earlier this week electronically are still in draft form. We've got a couple loose ends to tie up, but the numbers that we're going to be talking about, I don't expect them to change. I don't think there'll be any changes from the drafts that you got to the final. I want to start by thanking Daryl, Alaric, everybody in the finance office, all of their help, a massive amount of guidance and documentation and answering questions and all of that quickly and efficiently so that we could get to this point in the audit process. Conrad White is with me today. Our audit manager, Conrad, dealt with the day-to-day work during the audit process. I just come in at the end and get all the glory. So we're going to talk mostly from the executive summary this morning. That really summarizes the overall results. There's a lot of detail in the financial statements. We'll kind of hit a couple highlights in there, but mostly we're going to talk from the summary. Page 2 of the executive summary just describes the different results of the different reports that are part of the overall audit package. We're issuing an unmodified opinion. That's the technical term. It's a clean opinion. It means that the financial statements are fairly stated and don't require any modifications to be correct in accordance with accounting standards. So that's the kind of opinion that you want to get. So good news, that's what you're getting. Because we have to do the audit in accordance with government auditing standards, and because we have to do what's commonly called a single audit, the technical term is an audit under the uniform guidance. That's when you spend more than $750,000 in federal money. So because we have to do the audit in accordance with all of those standards, we have to issue 2 different reports on internal control and compliance. And so those are both referenced here on page 2. The audit that's referenced under government auditing standards is an audit of the county as a whole. And then the report under the uniform guidance is specific to the federal programs that the county administers.
Can I ask?
Sure.
Is these federal expenses of $42.5 million?
Yep.
Is that federal money we get or just federal programs and the amount of money we spend on them?
So the number, the 42.5, is what the county spent in funding that was ultimately from the federal government. A lot of that, of course, comes through different state agencies.
Right.
And that 42.5 includes money directly from the federal government, includes all the different state agencies that take federal money and pass it through to the county.
Thank you.
Yep. So both of those reports identified no material weaknesses, no significant deficiencies in the control system, no non-compliance with laws and regulations. So they're all clean reports. So good news there as well. Page 3 of the executive summary mentions a couple of letters that are not part of the bound packet, but additional letters that you'll receive as part of the audit process. There is a management comment letter. We use the comment letter if there are findings or things that we want the county to be aware of. Fortunately, there were none of those. We had no findings in this year's audit. There were a couple of findings in the 2023 audit that were resolved in 2024. So not only did you have no findings this year, you cleaned up the findings from the year before. So good news there too. And then because the county not only has a federal single audit, but also spends more than $750,000 in New York State Department of Transportation funding, there's another report on control and compliance specific to that state DOT funding. That report also is clean, no material weaknesses, no significant deficiencies, no non-compliance. County spent a little bit more than $16 million in state DOT funding. So that's not the federal money, that's the state share. Okay. Then page 4 of the executive summary mentions one more letter that's part of the overall audit process. We commonly refer to it as the communication letter. It just mentions several things. Auditing standards require that we make sure that you're aware of about the audit process. And that letter is pretty much boilerplate language. There's nothing in there to be too concerned about. One thing I will mention, there was mention in that letter of a change in accounting standards. There was one standard on compensated absences that was implemented this year. And so there are some changes in the government-wide presentation of the financial statements as a result of that standard. It's not specific to the county, it's an overall government accounting standards board change. So,
What does that mean? What do you have to report about that?
so it changes the methodology for reporting accrued paid time off and how it is accrued and calculated.
Okay.
Yep. And so beginning on page 5 are a few pages with some of the numbers, some of the trends, and with that I'm going to turn it over to Conrad.
Thank you. So really starting to take a look at page 5, we're going to start with a few pages on the governmental activities, really all your funds rolled up into one, plus any of the long-term assets that's with those and things like that. So looking at page 4, we can see the breakdown of all your governmental revenues. The biggest one, so of course, being your sales and other taxes, as well as your operating grants. Those came to about 58% of your total revenues, and really that represented about $150 million in revenues for the county overall. As you can see from the prior year, those numbers only shifted slightly between 31 and 28%. So really, from year to year, you're not really seeing much in terms of the fluctuations of what is really driving the revenue within the county. It's usually these two items. Then you'll have your real property tax items, 21%, 23% last year. Your capital grants and your charges for services really only accounting for about 15 to 17% of your total revenues for the year. So in total for 2024, we had a calculated amount of about $258 million in revenue across the county. In the prior year, 2023, it was about $237 million. When you look at the expenses on the other side, most of your expenses, once again, went to economic assistance and opportunity, 27% this year compared to your 28% in the prior year. From there, you have your general governmental support, then your transportation, public health, public safety. Now, we saw that in both years, I believe, yes, in both years, your expenses actually did outpace your revenues. So $269 million in 2024, $240 million in 2023 in terms of your expenses. And those both, like I said, outpace your revenues for both of those years. So we did see losses. Now, like I said, this takes into consideration your long-term assets and your debt associated with those. So some of the expenses related to that are depreciation expense that we have that we show over the life of a capital asset. So even though in your governmental funds you may show the expense up front, we, for lack of a better time, smooth it out over the life of the asset, whether it be 5 years for equipment or 30 years for infrastructure and buildings or things like that. So that's why the expense can differ between your governmental funds and your government-wide overall funds. Taking a look at page 7, we'll take a look at your general fund. This is the fund that we more than likely, more often than not, talk about and take a look at. So starting with your assets, your overall assets did decrease from the prior year about $28 million. A large portion of that has to do with your cash. Your cash did decrease about $30.7 million. We'll take a look in a couple pages, but you did have an overall loss in your general fund as well, so we can see some of that contributions. You did have a slight increase in your receivables. I think your STOA increased about $5 million. The state I forget what the acronym stands for, but it has to do with your transportation from the state. DSS did decrease, though, about $3 million in total receivables from the prior year as well. The other big line item that did increase was that due from other funds. There were some amounts between your general fund and your fringe fund that caused that increase, as well as some amounts from the capital fund that are due to the general fund as well that caused some of that increase from that 1.6 to that $9.2 million in your inner fund, in your due from other funds. When you took a look at your liabilities did decrease slightly, about $1.6 million. However, we did see a large increase in that AP and accruals. So as you have some amounts due from state and Fed for that STOA, you actually have some payables, which is the monies that you're more than likely giving over to TCAT for those amounts. That increased as well. And then when we look at the unearned and unavailable revenue, that did decrease. A lot of that is due to you using that money that you got for the coronavirus relief fund. So as you start paying that down, that is no longer deferred revenue. That turns into actual revenue for the county on the general fund level. So we did see a decrease in that. Your due to other funds did decrease as well, and the other line item slightly decreased, but those are some other some other smaller liabilities. When we look at page 8, taking a look at your fund balance accounts, your non-spendable was up slightly. That is really the prepaid expense that you have for your ERS. That's more of what is in that account. I think accounting for about 95% of that account. Your restricted did increase, and we'll take a look at that in a couple pages as well. Your assigned decrease, we'll take a look at that as well. And then your unassigned fund balance did decrease from 6.9 million down to about $44 million for the year. So overall, you did see a decrease in your fund balances from 81 million to $63 million. You did see an increase from the start of COVID from that 57 up to that 86 in 2022, and then it's slightly starting to taper off. There are different economic factors that can lead to this: increased payroll, things like that, tariffs as those start to become more prevalent, or and other increases for inflation. You might start to see more expenses creeping up, and how the county deals with the revenues in reaction to those will help determine where these fund balance levels will live in coming years. On the revenue side, there was an increase of about $15 million. The three main drivers of that was the state sources, the federal sources, and the other line item. Now, the other line item is where we put a lot of those fringe revenues from other funds. They're not technically inter funds, but as you spend money on your fringe benefits in the fringe fund, money coming over from your D, DM, and things like that, those roll up into that other line item for the revenue. What we also saw was in the state sources and the federal sources, those both increased, and those were for the same reason. Those also transportation-related revenue increases from both the state and the federal level. Yep, sorry.
I was wondering, for our investments and even for the money that's in our fund balance, where do we see the revenues for the interest that we've accrued?
So the interest revenue would be in that other line, should
Okay.
be in that other line item as well.
Okay.
I believe.
Thank you.
So, yep, so the revenues did increase. Unfortunately, your expenditures also did increase over the prior year as well. Those were up about $28 million, about $28 million over the prior year. So looking at your general governmental support, that increased around $4 million. The public defender's office in your general government support was a big reason for that, along with salary increases. But I think that in total, your public defender line item rose about $2 million over the prior year. In public safety, we saw a big increase in jail salaries, as well as some contractual expenses related to the jail. Economic transportation, where we saw those big increases in the revenues, we also saw big increases in the expenses, as you're kind of a flow-through entity to TCAT, where as you receive those monies in, you are expending them over to TCAT. So that was a big increase in transportation. And in economic assistance and opportunity, that was up about $7 million. Two of the bigger drivers in there were Medicaid and daycare. Those line items increased over the prior year, as well as the associated salary increases, benefits increases, and things like that.
I've got a question. So when you're auditing, like public health as an example, do you audit based on the expenses that are submitted through finance, or do you actually go to that whole health department and audit their numbers?
We usually start with the finance numbers themselves.
So we're relying on the data they provide through finance for the audit?
Yes.
Okay, all right. Thanks.
So overall, what we saw was an excess of the expenditures over the revenues for this year of about $18 million. About $18 million, which once again, that you can see through the cash also being down by about $30 million in the current year. Are there any other questions on the general fund numbers? So as we start taking a look at page 10, we'll take a look at some of the other governmental funds. The capital projects fund, the revenues did decrease by about $5 million over the prior year. A large portion of that was in the prior year, you did go out for a new bond. I think that was about $17 million. So there was a decrease as you did not have that revenue, but what increased was inter-fund transfers into the capital funds. So that kind of offset and helped with some of the decrease that you did see. On the expenditure side, the expenditures were also down. I believe in 2023, you finished up some work on green facilities and public safety. So those were done in 23. So with those expenses off the books, you didn't really see as much work done in 2024. The interfund, the debt service fund, the revenues did decrease from 13 to 6.6. Your interfund revenue in that fund was also down about $6 million. That was the main driver for that revenue being down.
What is TTASC?
That's the Tompkins Tobacco Asset Securitization
Gotcha,
Corporation.
okay.
Yep.
Even though that is audited separately from the county, we do include those as part of the county's numbers as a debt service fund.
Yeah, I understand. I just didn't understand the acronym.
Taking a look at your special revenue funds, those didn't really change too much, and both increased by about the same from 2023 to 2024. Now, special revenue funds really rolls up the remaining funds on the county's books, which usually would be your CT or your transportation or airport, your CL, your refuse and garbage, CD, your special grants, your D, which is road, and then DM, road machinery. I may be missing one or two, but I believe those are about the 5 of the bigger ones that we take a look at on a yearly basis. Taking a look at page 11, we'll take a look at the fund balances I spoke about earlier. The prepaid items, as I said, most of that comes from your ERS prepaid for the subsequent year. Public safety on the restricted side did increase only slightly. The county did have a new tax stabilization reserve, and you did budget for about $2.75 million there. Economic assistance did decrease, and then the new capital reserve that you also enacted took you in that capital reserve from $25,000 up to $6.1 million. On the assigned side, the amount appropriated for next year's budget did decrease by about $3.8 million. The RAA funds, which I believe was used to help with contracts that had not been. Sorry.
It's funds we set aside for our contract negotiations. At the end of 2024, all of them were complete and up to date as far as I know. So because of that, we adjusted it to show that we didn't have any set aside.
So do we need to start doing that again? Of course, it's nodding. Yeah, okay. Thank you.
So the other two in the assigned were the emergency communications, which did increase from 813. You hadn't put any money aside in that for a couple of years, so you took that up to 1.2 million. And then the encumbrances were down from 6.8 to 2.4 million in the current year.
May I ask, when you say that money's appropriated for next year's budget, is that like multi-year OTRs?
That could be included. It's anything that we budget to use fund balance.
Oh, okay, thank you.
Then taking a look at page 12, this is the outlook of your budget compared to your actual for 2024. So the county originally budgeted to have $217 million in revenues. It was revised to 254, and then you did beat your original, but compared to the revised budget, you were unfavorable by about $20.9 million for the current year. You brought in 233 compared to 254. On the expenditure side, you originally did budget for 217. Once again, you revised that to 261, and then you did come in under that by about $7.4 million. So your actual numbers which include your actual expenditures, including the encumbrances of $2.4 million, brought you up to the $253 million for the current year.
So when we look at the actual revenues of $233 million, which is $20 million less than planned, how do we identify where those revenues fell short? Is that a finance issue, or how do we identify where those revenues didn't come through?
Right.
We can look into it and we can try to provide some answers individually, but it's for many different reasons. So for one example off the top of my head is if we budget to use so much and that's all covered with grant funding, if we don't spend all that amount, then we don't get the opportunity to report that revenue either. So I know in some cases, if we don't pass all the funding on to the mental health providers, then we don't record the revenue from OASIS. And that's just one example. So we can look into it and I can work with county administration. We can try to see if we can narrow it down a little more, but a lot of it depends on grants and whether or not we've used them.
I think one thing that we've done over the years too, Randy, is we've added positions. And whenever we do that, that of course adds to our bottom line. And that is a year-over-year expense that we're going to continue to carry forward.
So in comparing that to the 2023 budget, your 2023 budget, you were also under budgeted on the revenue side, but more importantly, for our view, you were also under budget on the expenditure side as well. So all in all, we do more, even though we are concerned with taking a look at the revenues as well, we are more concerned with taking a look to make sure that you are under budgeted in terms of your line items when it comes to the expenditure side of your budget. Taking a look at page 14, now this net position analysis brings into consideration all of the long-term items that I spoke about earlier. So overall, for the county as a whole, there was a total net position of $171 million for the current year. $190 million was locked up in net investment in capital assets, which is all of your capital assets less the debt associated with funding those projects. $24 million was restricted, which brings into consideration some of the capital funds as well as whatever was restricted within the general funds. And then unfortunately, there was an unrestricted net deficit of $43 million, which also correlates to some of the losses that we saw, especially in the general fund as well. So even though that is a larger number than what we've expected in the past, what we also do is include a reconciliation at the bottom to show what this would have looked like without some of the items that you can't really budget for on a yearly basis. Your GASB 68, which is your ERS liability, and your GASB 75, which is your OPEB liability. These are items that we have been tasked with also reporting for the county, but there is no budgeted item that you can then say you're going to put that you can budget for on a yearly basis. So in all, the GASB 68 and the GASB 75 liabilities, which are just on your government-wide, came to about $110 million, which added to that bottom line, that bottom unrestricted deficit line. Without those two, we would have seen an unrestricted net position of about $68 million instead of that deficit, unrestricted deficit of $43 million. Are there any questions on those numbers?
Yeah, so on the GASB, these are new government accounting standards.
So
Is that what that means?
yeah, so these standards, I believe 68 has gone back to 2015, GASB 75, I think a few years after that. They really want to be able to show not only the liability associated with the county, but also the deferred inflows and the deferred outflows that should be associated. And what I sometimes say is, if the county was to shut today, how much would the county be on the hook for? And we all know that the county is not going to shut today. And so these liabilities, which are actually determined given interest rates or what the expectation of the current workforce, what the expectation of the future workforce is, these are their actuarially determined estimates, not really a concrete liability for the county itself.
Okay, thank you.
But isn't the reason for the standard because so many municipalities or states or counties, other places have not taken those future pension debts into account and are spending more than they should and not putting away what they should. New York seems to be a little better position than, for example, Illinois. But isn't that what really Gatsby's about? And it's to keep us aware that we will have these expenses.
Right, yeah.
So when you look at the state level, the state audits, especially the Gatsby 68 on a yearly basis. At the end of March, they put together their entire liability. And especially for that, what we have here of this $17 million is the county's portion of the state's liability that they're passing on. Now, as you said, New York State is very good at how they do their funding. I believe that we've consistently been around 90% or over 90% in terms of how well funded the liability actually is, when other states are well below that 90% or even 80% level. So yes, this, especially for 68, that is the liability given our portion of New York State. Gatsby 75 is what the county is an actually determined number of just the county itself.
Thank you.
Any other questions on any of these numbers?
Sorry, could you just recap what the first few lines mean again?
The net investment in capital assets.
Yeah, or what are these numbers representing exactly?
So this is taking not only the general fund, but the county as a whole, including all of the fund balances for all of the funds, but also including the county's capital assets, and including the capital's debt, other liabilities, including these actuarially determined liabilities for retirees, retiree health insurance, and pensions. So that's where that total net position comes from. And then it's broken down into those three categories.
Okay, and the actuarially determined liabilities is how the whole thing can go negative?
Yes,
Okay.
correct. Right. And I'd say it's pretty common. I mean, certainly, I'd guess probably 90% of the governments that we work on and audit have a negative in their unrestricted net position because these liabilities exist on the government-wide financial statements, and there's no assets set aside for them, right? Because the asset is the county is going to fund that retiree health insurance for the next 40 years or however long those people are going to be. And the same thing with the pension liabilities. The last page of the executive summary just mentions the current future accounting standards. So as I mentioned before, the statement on compensated absences was implemented this year. And in the financial statements on page 65, there's a note about the restatement. So on the government-wide basis, the county's calculated compensated absence liability increased about $800,000. Mainly that's because under the old standard, if it was something that couldn't be paid out at retirement, it didn't get calculated. And now there's an additional amount calculated for things that aren't going to get paid out but are likely to get used by current employees before they retire or leave. So there's more of a liability is calculated under the current standard. And then there are some standards that are coming up over the next 3 years, varying amounts of impact on the county's financial statements, but we just wanted to put them in there so that you're aware of them upcoming. There is a lot more detail in the financial statements themselves. I'm not going to go into any great level of detail, but I do want to mention a couple of things. I know that you received them earlier this week. If you're not going to read through the entire 85-page document, I won't be offended or surprised. But I do want to mention a couple of things that I think you should read. The management's discussion and analysis in those financial statements. It's about 15 pages long. It starts on page 5. It goes through page 5N. That section, without a lot of detail, gives you an understanding of where the county is financially. There's some charts, there's some graphs that are helpful in that section. There's a lot of narrative describing things that changed from one year to the next. There is a lot of narrative about upcoming, future capital projects, future issues that will implement or will impact the county's financial statements. So I'd really encourage you to read through that section. And then the other thing that I wanted to point to in the financial statements, just to highlight it, we talked about the county spent roughly $42.5 million in federal money. There is a list of programs, begins on page 80, goes through page 83 of the financial statements, and it lists all the different federal programs that the county administers, so you can see where that $42.5 million number comes from. We have to select kind of on an annual basis based on the risk associated with each program and the frequency with which those programs are audited, determine which programs we're going to test. For 2024, we tested the coronavirus program, the federal transit funding, and the TANF program. Again, we have to kind of change the focus every year. We can't just test the same 3 programs every year. And as I mentioned at the beginning, the county had no findings with respect to those federal programs. So with that, I'll open it up to any other questions anybody might have.
Let me start, if I may. We're about to enter what we believe will be a tough budget season. Mm-hmm. And we traditionally have, at least the last few years, a real discussion about our fund balance situation. Mm-hmm. And last year, certainly at the recommendation of our Director of Finance then, increased our fund balance projection to 25%, I believe.
Unassigned.
I'm sorry?
The unassigned.
Unassigned, yes. And I just wondered if you folks have any recommendations on that for us, or any cautions that we should be aware of when we're looking at fund balance as far as whether it's spendable or whether we should be reserving it or what? Mm-hmm.
So I think 25% of unassigned is a pretty good number to target for. I'll start there. The State Controller's Office doesn't really give a recommendation, but certainly in other guidance places like the National GFOA, those national organizations, 25% seems to be a pretty regular percentage that I hear. So I'd echo that comment. The county does, as Conrad had mentioned, set up a couple of new restricted fund balances, reduce the level of assigned fund balance, the amount appropriated for the 2025 budget. That RAA funding got rid of those. So restricted numbers go up, assigned numbers go down. The unassigned certainly went down during 2024. So I think the percentage that you're targeting is a pretty good percentage.
Okay, thank you.
Yep.
Other questions? Randy?
Yeah, so looking at how audits are done in accounts payable and accounts receivable, and that you explained that you're recognizing when a department submits an invoice for payable, it goes through finance, right? And that's what you're auditing. Mm-hmm. So do you have any understanding of expenses that are from a particular department? Are they ahead of their expenses, or are they behind on invoicing people, or do you have any feeling for that? When your revenues are $20 million less than planned, how can you possibly budget if you have no idea what your revenues are going to be for $20 million less than what you planned? So, I mean, and that just, so for me, if I don't understand DSS, and I looked at your numbers, and I did spend 2 hours going through this already, and I'll spend more time reading that, what you stated. When I look at that and I go, well, that doesn't make sense to me, but now here we are, 18 months later from January of last year, trying to figure out what happened. So I'm not blaming you at all, you're just doing the numbers, I'm just saying that. So do you have any recommendation on how we can do a better job of looking at our existing expenses for 2025 before we go and budget in 2026? So, I mean, how do we know if this isn't going to happen again? Also, we're $20 million short again in revenue.
Plus you got to add the $880-some thousand that we just distributed because they had an immediate shortfall.
Right, our expenses were I think a little less than our revised budget.
Correct.
But how do other people deal with this? And are anybody else doing evaluations of specific departments to understand what's going on here? I mean, when our expenses are continue to climb, which they will, and our revenues could be at risk federally, right? So how do you, I mean, the state's looking at a budget crunch as well of $30 billion short in their future budget. So what do you suggest?
Right. I guess I don't have a lot to add other than what you've said. I mean, the county has more control, I think I'd say, over the appropriation side of things. Right, I mean, especially the state and federal revenues, those numbers are based on, as Daryl said, grants that get filed. If those grants don't finish, you don't have the spending, but you also don't have the revenue. So those numbers are difficult to pin down. The numbers that are more straightforward, things like property taxes, those numbers are pretty close from a budget perspective, obviously. The sales tax numbers were pretty stable from one year to the next. The biggest decreases or the biggest shortfalls from a budget perspective were in that state sources.
In what sources, I'm sorry?
The state source revenue was about $6.2 million short of the budget. So that was a pretty significant reason, for the overall difference.
Okay.
We talked about this in other meetings about having departments provide reports. Mid-year, quarterly, or whatever is what's going on there. Are other counties doing those types of things? Or our system we're updated our system quite a bit in the last couple of years, OpenGov.
Right.
But are other counties that you're auditing getting earlier data than us?
I don't know that I'd say earlier data. I mean, every county is a little bit different. Some are more centralized than others. Some of the counties that we work with, and going back to, I guess, your original question about the different departments, some of the counties that we audit are pretty decentralized, I'd say. The departments do a lot of this stuff, and the, finance office, county treasurer's office doesn't really get involved till the end, so to speak. Here at Tompkins, it's more centralized. The finance office is in control, involved earlier, I guess I'd say, in terms of how the financial aspects of those things work. So some counties do rely a lot more on departmental reporting, departmental control, but those are the counties that have a more decentralized system.
Daryl?
I apologize. Normally I
I'll
don't.
get you, Shauna.
But no. I would have to add, in my opinion, we're more decentralized. We get the information from the departments after the fact, and we rely very heavily on the information from the departments. And in most cases, our processes we do not get those figures till after. I just wanted to add that point. I can also add to Randy's questions. We have resurfaced an old accounts payable policy, which makes the departments do a PO of anything over $250 that may help increase our chances of catching expenses earlier. And we are working on a revenue policy, a receivable policy that's in works right now, and I'm hoping to send a GO of it shortly that will designate certain timelines for departments to submit their state claims, and that should help with the revenue side.
Thank you.
Shauna?
I just want to say kudos to our accounting department, county administration. I think what we've seen, especially with some of the local municipalities in our area, is that these audits are really important for us as lawmakers and as people that are creating our budget for the upcoming year. I can't imagine not receiving this report every year and then trying to go forward and build a budget, because you don't get the full picture. You're basically just spending willy-nilly and hoping that the cards fall and hoping there's money in the bank. And so, every year I really appreciate you all coming, providing the numbers for us so that we can base our upcoming decisions. And I understand what you're saying, Randy. It's still, information that's 18 months, late. So it's not, truly actual numbers, but I think it does give us a pretty good picture. And, I've always been impressed with the county that we prioritize having the data in our hands so that we can make really good decisions whenever it comes to budget time.
Well said. Anyone else? Corsa?
Yes, I just also want to get to Randy's point in terms of the revenue and the expenditure. So departments comes in with the resolution to accept grants and then ask the finance office to amend the budget in recognition of that grant that they have received. That revises our revenues. But if we are not able to submit the reimbursement and get the money in time at the time of auditing, that will show the gap in that revised revenue as against what actually came in. So sometimes not really there's something wrong. It's just about the fact that we are not able to receive some of those funds before the auditing process happened. And sometimes we have an expenditures late in 2024, maybe we paid that actual encumbrance in 2025, so we haven't actually been able to submit the reimbursement to get the money back yet.
So it's a cash flow issue.
Yes, so that would just show those gaps as well. So the fact that it's a significant negatives doesn't really mean there's something wrong. I look back at 2023, it was just about 1%, which is great. So it's not like there's a consistency of that gaps. There's one off year of that significant, almost 9% gap in revenue versus expenditure. So something that we have to look into to see where that $20 million is. But don't forget, if you look at the first line, is property taxes of about $2 million, which means that potentially we didn't receive the expected property tax that we were expecting due to other delays or things like that. So there are various aspects that goes into that we will examine and find out and see how we can help move the curve forward. Like as Dara said, with the new fiscal policy that we're trying to put in place, which requires departments to submit their reimbursement on a quarterly basis, that will also help us to be able to get the money in as quickly as possible.
Okay, well, gentlemen, we really appreciate your coming and the thorough discussion and all of the information we have. For several years, the whole budget committee has acted as the audit committee, and we do that because it's all part of our intent to make our budget process as transparent as possible. And of course, you'll be coming to the full legislature with this when you're completed, but the more people who are involved in understanding the budget, the better decisions we're able to make.
Right.
Okay.
All right. Thank you very much.
Thank you.
Thank you.
I did want to mention that we had, quite a few minutes ago, we were joined by Veronica Pillar, one of our legislators. And Veronica, we have your opportunity to update us on Workforce Diversity and Inclusion Committee.
Yes, thank you, and apologize for missing the first few minutes of the meeting. Not a lot to report from WDIC, other than starting this month, we're going to begin hearing from a few departments about their equity indicators and progress on those. Fuller reporting is going to be in the institutionalizing equity report that our Chief Equity and Diversity Officer is leading. But there are a few departments, and I'm not trying to be cagey, just they're not scheduled yet, who would like to come share with us live. So look out for that. And then not specifically committee related, but I'll take the time to remind people there are still spots left to sign up for the GARE Government Alliance on Race and Equity Regional Convening happening in October. So look that up and come if you're at all interested.
Questions for Veronica? Thank you, Veronica. I want to talk about the Tompkins Intergovernmental Relations Committee. Deborah, we put this on for you, but Sean is the chair. Who's doing this?
I just wanted to ask everyone to listen to that recorded meeting. Look for the presentation by, is it Alex Reagan, Shauna? The woman from NISAC. She gave us an extremely detailed and concise presentation on how the implementation of provisions in the One Big Beautiful Bill Act are going to impact us, perhaps not immediately. Most of the provisions that affect Medicaid and SNAP will go into effect right after the midterms, which I'm sure is just a coincidence. But the impacts on the county of the additional expenses of monitoring and implementing the employment requirements, for example, for both Medicaid and SNAP. And then you add in the number of people that may lose their benefits and have to access other programs that the county pays for. If you put all of that together, she gave us an estimate somewhere between $2.5 and $3.5 million annually for the county. If you translate that into percentage increases on our tax levy, that's huge. So we need to be prepared for that. I'm not exactly sure how we prepare for that, but we need to keep those future impacts in mind as we proceed with our 2025 budgeting. That's it.
Anything you want to add, Shauna?
I think what's important also is the programs she said would be affected next year are going to be our SNAP benefits. And so if people are losing SNAP benefits or reduced benefits, then we are going to see an increase of people that are struggling with food security. And, you know, at some point we might have to think about supplementing those individuals through our nonprofits. I think the other part is that she said that the Medicaid cuts really, we probably won't see those till 27.
Right. But I think we need to bear in mind the impact that those Medicaid cuts may have on our healthcare providers locally. I'm sure you're seeing in the news that a lot of rural regional health centers may be impacted to the extent that they close down. And the reason for that is if you don't have Medicaid, then you're going to go to the emergency room when you have a health problem. And if Medicaid's not reimbursing the healthcare provider for those visits, it increases the costs overall of providing care to everyone else. And eventually, the books don't balance and things close down. So, yeah, we're headed into a dumpster fire on the Titanic.
Is there, is a lot of this related to workforce requirements? They're going to require 20 hours a week of actual work
It's like
or
80 hours a
volunteerism?
month, yeah.
I think the one thing that Alex pointed out too is that the work requirements, but it's really going to add stress to the people that are on the ground. And so these extreme work requirements are going to just be too much for most people, and they're not going to do them. And it's
Or
also
they
going to
can't.
add extra stress to our staff that are on the ground.
Right.
Yeah, because it's not clear at all who's actually going to do the job of imposing, monitoring, enforcing those work requirements.
Right.
And the way things generally work is that kind of stuff rolls downhill. We're the bottom of the hill.
It may be a benefit to people that are already volunteering, right? So if people are already volunteering, there's a lot of people who do volunteer. Like Cornell Crop Extension, they have a lot of volunteers there. I think there's 80 of them, that maybe it would enable them to receive benefits if it was tracked correctly, if they weren't receiving benefits already.
Well,
So-
I don't think anybody's actually seen the work requirements, the specific work requirements laid out.
Right.
From the stuff that I'm reading, it sounds like they have to go to some kind of workforce training. Who's going to provide that? There's just a lot of unanswered questions, but the consensus seems to be that these things are designed to push people off Medicaid, push people off SNAP.
You know, the last administration who did that was under Bill Clinton,
Yes, and
workforce requirements.
I think that's a good
What
point.
about?
Yep.
And what happened after that when they reduced the federal time on welfare to, what, 5 years, as I recall?
Yep.
And, all these folks are going to get jobs then. Well, guess what? We had to pick it up in the safety net program, which what we used to pay 50%, now we pay 70 or 80% of.
Yeah.
75.
And it's just got kicked down to us as usual, and we have nothing but the real property tax to be able to compensate for the various losses. And
Well, we have sales tax, but if you read the latest edition of the Ithaca Times, our retail sector is crashing.
yeah, but we don't really control the sales tax.
No, I know, but I'm just saying.
It's just whatever the
that could
spending
go down
is.
too.
Well, we have to make a decision about the real property tax every year. And that's the hard part, as you know. And New York State is already the highest tax state in the nation. There have been some recent surveys on that, and we continue to be that. So as much as we wouldn't like to be in that position, when things are pushed down on us, we have to react. Thank you for the report, and we'll try to take a look at that section of your YouTube. Corsa, would you want to talk to us?
Yes. Okay, so just want to provide you a bit of an overview of where we are in terms of our budget process. I was on the phone with Norma at 10 p.m. last night. Sorry, I called. So when we met and we discussed the numbers we were looking at, so maintenance of effort requests that came in from department and agencies produced about a deficit of 11 million. Basically, what the component of that was $6 million more in expense, and $5 million more in expense, and $6 million less in revenue projections. That's where we got our 11 from. So the goal, as we go through the review process, is to see how much we can close that gap. Is there other expenses we can adjust downwards, and are there other revenue projections that we can adjust upwards? So that have been the key things that we've been doing. There are items that are extremely very tight for us to make any adjustments on. So we've been working with the departments and asking them by themselves to go into their projections and make adjustments. So several departments have revised their revenue numbers up, not just revising it up, but looking at historic inflows and making a candid projection on how much can really come in. And also several departments are also adjusting their own expense numbers to try and help us close that gap as much as possible. We have also had conversation with several of our external agencies and informing them of the possibility of not being able to hit our target allocation to those agencies. And we are asking them to also review their expectation from the county. And some of them, we have told them specific numbers to see if they can adjust their expectation from the county based on those numbers as well. So those conversations are also ongoing. Besides that, we are looking every single budget line. And even though we had an initial target that is usually set, and we have not deviated from that process, but we are evaluating previous expenses for the last 5 years and making decisions on what departments are projecting to spend in 2026. And then asking questions why there's a significant increases or there's less amount. So we are not just telling department to cut expense. So for example, if a department has a budget line that every year for the last 5 years they spent $2,000, but they're projecting to spend $500 in 2026, we are asking them why. Because we want to avoid a situation whereby budget lines are transferred from one to the other unjust. So we're trying to control some of those processes. So we're having that candid conversation with all the departments, and we are getting to a very good positions right now. I think currently we have recommended approval through some of our processes, some of the maintenance of effort numbers, and we've also, there are few enhancement or over target requests that we are looking at which are essential that we are also potentially will recommend in the recommended budget. But the gap right now is around about 9 million, which is pretty much about 13%. The tax levy from the 20% in the maintenance of effort that we provided when we met. So we are hoping to be able to bring it down as low as possible in the recommended budget. In addition to that, learning from your previous experiences, we will provide you the list of all the adjustments that we have made, all the requests that came in, be it over target requests or maintenance or for some of those one-time expenditures that we have. I'm seeing multiple items that I think the legislatures approved a couple years ago, 2-year, one-time, or 3 years. We have the list. We will provide you with a list of all those items for your consideration. There are some of them that are very essential, and the department has weave into their program and some of those one-off positions and items, and some of them we are actually recommending to be in the recommended budget as well. So we're going through all that processes. We are hopeful that we will be able to get you the tentative or the recommended proposed budget by the end of next week. But it's going to be extremely tight. We have to be working a couple of weekends to be able to do that as well. So that's where we are. We are confident that we'll be able to provide you a proposed levy rate that will be favorably considered by all of you as we go through the process. In addition to what Nsiro also indicated, the fund balance numbers is what it is. It's 44 million, but we have a significant restricted fund balance like the capital and things like that. So you have made some very good decisions in the in the past as well, and all those are being considered as we go through the processes and examining the approach we have to take in coming to a number that will be reasonable in our estimation. So we are working on that on a daily basis, and that has pretty much been one of the things that is focusing our attention a lot this time. So yeah, so that's where we are. We are close. We are very close. I'm confident we'll be able to get to lower number that may be reasonable for you to consider. And Yeah. I'm not going to call you at 10 p.m. again, but I can't promise it. But so we're trying our best on that. Besides that, no, so that's all I have. We have a few items to discuss later on, but.
We appreciate all the work you and your staff are doing on the budget. We know it's not easy, and we thank the departments for all the work they're doing as well to try to assist. Would it be fair to say that the $6 million decline in revenues is mostly due to less federal and state aid?
Yes, it could be. Because
like in the DSS and places?
Yes, one of the biggest biggest contributor, also part of what Nsiro indicated, is the public transportation. We received significant amount of inflows last year by, what is his name again?
Stoa.
Yeah, from Stura, and we are not expecting the same level of inflows in 2026. That is also contributing to the decline in revenue projections in many areas as well. So yes, and with everything happening at the state level, department are really projecting conservatively on what inflows will come in.
Deborah?
I think part of the problem with transportation assistance too is that last year, we finally got a leadership team at TCAT that delved into all these outstanding grants. I don't begin to understand how transportation grants work, but apparently they're reimbursements, obviously, and apparently you have to link all of your actual expenses and document them and attach them to the appropriate grant and submit that. And that process went into overdrive last year with the new leadership team. And so a lot of those grants that were in place for years finally got documented and claimed and distributed. And once we've eaten those all up, we have to start over with new ones. And I think that's probably a big piece of, it's not just the STOA.
Not just the STOA, yes.
Yeah.
Aren't a lot of those awarded on a multi-year basis, so they're not necessarily annually billed in?
We want to get Shauna.
Yeah, they are. And I think on the back of what Deborah said, I think our team dealing with public transport is doing really good work. We are in the process of the tri-annual review process that they have really provided a lot of. We sat in on Monday, and they were very impressed with the work that we've been able to do in terms of our documentation, in terms of our reporting, and all those processes. And one thing I just want to make clear, the money that we receive and the buses that we buy for TCAT are county asset. We are liable for them. They are our property. They are registered in our name. We inventory them as our property. So, for example, if TCAT is not in operation tomorrow, the county is responsible to taking about that operation. It's our operation. So we need to be aware of those processes, and we need to be aware of our responsibility in the public transportation arena and making sure the decisions that are being made are also protecting the county. So they are not an external agency, they are a subset. We are receiving the money from state and federal and passing it on. So if something goes wrong, we are liable for them. So it's important that we are aware and we are interested in the decision-making process happening around the table and making sure the right things are done with those resources that we are expanding to those agencies.
Shauna, sorry you got jumped over, but you're next.
No problem. I just wanted to confirm as well, so with STOA, what they're saying is that for the past few years, they've held us harmless, and they've essentially paid what they were going to pay pre-COVID whenever our ridership was really high. And now they're saying that they possibly will not hold harmless and that we won't get that funding. The thing about it too that I hope we're noting is that there are 3 partners with TCAT. And so ideally we should only be responsible for a third of that, the funding, if we do not receive the hold harmless. Is that correct?
Not necessary, but the federal and state give county the money. So everything that is federal and state give to us to buy, we are liable for it 100% because the funds come through us. So the state doesn't give money to Cornell or the city, they give it to the county. So we are.
Right, I do understand that,
so
but what I'm saying is that each partner comes in at 1/3. And so
Absolutely.
if we're seeing less revenue come in, then it shouldn't be us picking up the burden of 100%. It should be each partner picking up the burden of 1/3.
And that's in the transportation agreement.
Yeah.
If there's a shortfall, the underwriters have to split it 3 ways.
Yeah.
Yeah,
I just hope that that's the number that's calculated and not the county picking up 100% of the variance that's going to be created with STOA.
Yes, that is the case. That is the case, and I think what I'm trying to get us to start thinking about is our interest in the operation as a whole, which I'm not saying it doesn't exist, it does, and we have very good people, the two of you, paying close attention is what is happening over there. And yes, if for any reason they are struggling, apart from the money we receive to buy these buses, the other agreement in place will be what will be enforced. But at the end of the day, I'm looking at that capital asset that is bought by federal and state dollars.
Deborah.
Well, another piece of this is that there will be a fairly substantial ask from TCAT to the 3 underwriters. And when we consider that, I urge you to remember that if there's an operating shortfall, we're on the hook for 1/3 of it anyway. So we're better off investing in advance to make sure that doesn't happen than to withhold the assistance that's needed and then find ourselves on the hook unexpectedly later in the year.
Might be a good time to mention, and thank you, Deborah, for your email on it, that the TCAT annual budget presentation is scheduled for the 16th of September
At 10
a.m. I don't know where we're going to do
It's
that.
at TCAT,
At
in
the,
their big conference room.
Transit building then.
That's my report.
Thank you. Any questions for Corsa? Okay, let's go to Director of Finance, Daryl.
Just give me a moment and I'll share my screen and go over my reports. So the first one I'll go over is our 2025 second quarter sales tax.
And these are a little different than the ones that are in our packet?
No, these should not be. The only documents that I updated with the email to you guys last night had to do with the financial statements. Those.
Okay.
Yeah, and that just had to do with the fact that they corrected a few items and removed and verified some numbers in between the timing of the deadline for BCP agenda and.
All right, so the figures we have here are good then?
Correct. So the total sales tax for second quarter 2025 is $20,990,899, which is 5.01% change over last year at this time. The county share of it kind of follows the same increase, which is 5.01%, which comes to $11,807,000 increase over from 2024 at this time of the year. The municipalities had a bigger increase at 8.14%, and the city of Ithaca had an increase of 1.84%. We budgeted in 2025 $43,240,000, which brings us budget to actual about where we need to be, 50.33%. On my next screen is kind of the graphs that show compared to last year. We are a little higher. I can also say from the comptroller that overall in the state, on average, all the counties and municipalities are seeing a 3.7% increase over the prior year. I can answer any questions about the sales tax before moving forward.
Deborah?
Somebody asked, I think at a recent meeting, if these numbers were, I don't know what the right word is.
Estimates versus actuals?
Right.
So, and that was Ann's question, if I believe I remember right. Typically, when we do the monthly, those are more estimates because there's kind of a cleanup piece that happens.
So
However,
are these cleaned up?
Yes.
Okay.
Yes, but I did kind of look back, and it all depends on timing too, that the ones that I did present do match with these, the ones that I presented for June. So in that case, by the time we got the information and put it in here, it all lined up. But that is not always the case, so we consider the monthly presentations for the sales tax to be estimates, and the quarterly more accurate because there's a kind of cleanup piece from the state.
Thank you.
Yeah, and I just want to add that they usually do this cleanup on a quarterly basis, the third month. So if you get the June numbers and they are tight, then you get excited because they usually will claw back if they paid you excess because these monies are paid to us in the on a monthly basis. So if they do their balance and they realize that you receive a lot of money based on the actuals for the quarter, then they'll claw back into the third month. So usually that's where we really pay a lot of attention to what happens, what comes in March, what comes in June, what comes in September, and those numbers.
I think in government reporting, it's often happens that the desire for recent figures need to be adjusted once there's more time. I think we just saw that at the national level, didn't we? With the Bureau of Labor Statistics, where the messenger got fired because the administration didn't like the figures, and they get changed. And that's what happens. It's not sales tax, but it's other figures that have to be trued up after a certain length of time.
So if we don't like Corse's budget, we just fire him until we get somebody.
Well, yeah, and then we'll get somebody else that'll come in and say, we just won't give you the information as often, you know. Okay, go ahead. Anything else? Go ahead, Randy.
So if I'm looking at the sales tax report correctly, it looks like we're $1.5 million above our planned budget at this point.
No.
We're $1.5 million over last year, and I think we budgeted less than we actually brought in last year. Is that correct?
It appears we're about $1.5 million over what we brought in last year at this time.
Okay. So Bidenomics is finally working, which is great. Also, it was interesting to see that the Obama administration overestimated 1.5 million jobs last year themselves, and they finally reconciled that. So it took them a long time to reconcile it. So our government is not good at counting sometimes. So
I would just say that we've traditionally been conservative in our estimates of sales tax. Yep. And what we don't want to do is try to say the same amount that we think it's going to be and then end up with a downturn. I remember during pandemic when we were the one county in the state that had a huge reduction in our sales tax. We just have to be very careful.
Mike?
I
think we also could see, and I don't want to jinx the county or anything, but we know that Cornell is facing some hard times right now and some scrutiny from our federal government, and many of their grant funds and research funding is on the line right now. And, you know, for better or worse, we're tied to Cornell, and their economy is our economy. And so if we do see a reduction in their research staff and the staff at Cornell, we're going to be hit really, really hard. So I think we need to keep that in mind as we move forward, because we definitely relied on Cornell. We rely on them for our economy. We rely on the parents coming, spending lots of money in our county. And whenever COVID hit, the students all went home, and we definitely saw a decrease in people spending money here in the county.
That's right. Anything else on sales tax? Carol, go ahead.
Okay, my next report is going to be the quarterly investment. So page 49 of your packet, or on my screen that I'm showing, shows kind of the pie of all of our banking, all of our cash. The total comes up to approximately 143 million. But if you look at here, it shows the split up between the banks or the investments, because NICLAS is on there. So on the next screen, this shows the cash balances by investment type, a little different from the prior screen. This shows by money markets, savings, checking, NICLAS, and CDs. I do want to point out that our amount in checking does look large. However, about half of that is in a special checking account with Tompkins Community that is earning 3% interest, a little higher your typical checking, as we're still working out our cash flow to move things around.
Is that 3% account restricted in any way, or is it like a CD? How does it work?
It is treated as a checking as far as I know. And that's based on historically a certain amount is sat in there. So if we were to draw down on it, and it is our capital project account, so as that goes down or if it moves drastically, there is a chance that Tompkins Bank may adjust that rate. But our goals are to improve our cash flow estimates so that we can invest those funds in other places.
Thank you.
Randy.
Yeah, I think the Finance Department's done a very good job over the last couple of years of managing our funds and getting the interest, and I'm glad to see that Tompkins Community Bank is stepping up and paying that 3%. So, yeah.
Now that is only for, I want to say, about a third or half of that, but we're working to improve that.
Good job.
Thank you. The next screen shows all of our interest amounts based on the CDs. Pretty much everything's in there with the exception of our checking account. Now this shows our cash balance showing from last year in July up through June of 2025. And as you can see, there's also the trend line, and it kind of dips. That's as we're spending throughout the year, and then when it goes back up is when we get our property tax. This one shows a similar type of graph, but with our monthly interest earnings. To address any questions ahead of time, if you're wondering about that big dip down, that has to do with the way we're recording our CD interest. We're recording it based on when it's mature, with the exception of year end. We're looking into changing that process to record it more monthly, even though it hasn't matured yet. That should smooth the line out a little bit. But that's why the dip down, because it went up for the CD interest and then went down as we're moving things around. This shows our budget to actual for interest. I do want to point out that all of our interest budgeted is actually in the general fund, but all the interest in the bottom graph is not. That is all the funds across the board. Any questions? Okay, I'll proceed. The next report is the adult use cannabis tax. So the total received from March to May of 2025 was $77,873.23. Of that, approximately $20,000 was for Dryden, $37,000 for the city of Ithaca, and $19,000 remains here at Tompkins County as our 25%. And this just shows the same information, but the graphs over the years.
I just have one observation, and that is that cannabis sales were at an all-time high during and around the election.
Well, that could explain the result.
Yes.
Another interesting point I just learned is that although our health department is able to monitor to make sure that sales of tobacco are not being made to minors, apparently our health department is not able to do the same thing with the cannabis sales. So I don't know whether the state is policing that or not.
Yeah. The state generally does its thing by, showing up every now and then at illegal dispensaries and putting on a grand show of shutting them down, and then they reopen in a few days. However, our local enforcement initiative directed at landlords in combination with the city is proceeding. The information needed to pursue those, the undercover buys, are proceeding, and we are hopeful, I don't know if it'll line up exactly, but to be able to announce something proximate to the opening of school on that initiative.
Thank you, Maureen. Other questions on the cannabis? Okay.
So my last quarterly report is on the contingency account as of 8/5/2025. I did it to that date because of the approved resolutions that used contingency done that were passed on 8/5. So because of the coloring, it may appear that we have remaining contingency funds, but it's actually in the negative. We have overdrawn our contingency fund $30,777.21. Of that is actually a piece that's encumbered but not spent yet, because that was the wishes of the legislature to encumber it. So we created POs for those to kind of hold the funds to show that they are anticipated to be used in a certain place. And those totals come to $454,371. I do want to add.
Is that the amount by which we're underspent?
We're overspent by $30,777.21. I do want to add one more point before I open it up for questions. There is another account called the mandate contingency account, which I did not show in here because I kind of reused Lori's graphs for this report, and it didn't include that at that point. That one is also overdrawn by $20,000 as well.
Like
Any
my
questions?
daughter's balancing her, no, sorry.
And the reason we don't have a casino report this month is what? Does it come in?
Due to timing, I can email you guys. I can put that report together, but I did not include it in this one.
Yeah, I didn't know whether that was quarterly or semi-annually or whatever. Okay, that would be fine. Thank you. Other questions for Darrell on any of the reports or this final report? Deborah?
May I move the acceptance of the financial report?
Sure.
I second.
Any discussion on that motion? All those in favor? Opposed? Carried. Anything else for us, Darrell?
I don't have anything to add other than that.
All right, thank you for your reports.
Thank you.
Let's go to Ruby Pulliam, our Human Resources Commissioner.
Hello, everybody. First, I want to start by thanking the legislature for their support of the county employee picnic, which took place on yesterday, as hot as it was. To let you know that extending the hours from 2 to 6 and adding that last vendor helped to alleviate the long lines and able just to make it more manageable. So thank you for that. A survey will be going out to all employees either today or tomorrow, trying to get an idea of what we will do for next year's picnic. There were a couple of suggestions during the last month or so. We just want to make sure we get an idea of what the employees are expecting. But it was a wonderful success, and I'm thinking 400 plus at least. I'm a little bit conservative in my numbers, but it was a good time. And thank you all for those who were able to attend. To follow up on a few things.
I would just follow up and just say it was terrific and well planned and well done.
Thank you. Staff appreciates it.
Veronica?
Can I, seconding what Mike said, and also I ended up lingering toward the end when it was mostly just the HR department packing things up, and so I want to give just extra thanks to all of you. I think it was pretty much the whole department there doing a lot of work to clean up raffle buckets and everything and pack them into vehicles, and then I went home, but they went to unpack and do more, and they were there the day before the picnic and early at the picnic doing really a lot of physical work to make it the success that it was. So thank you.
You're welcome. Thank you. We thank you for your support. And I can tell you I have one exhausted staff today. But it's okay. So things may be a little slow, but we enjoy doing it. Okay. And to follow up on some things that were mentioned in our last BCP meeting, HR, we have looked into offering a lower cost health plan. We've been talking and discussing it with county admin and labor unions, and there'll be more details in executive session. And also on the parental leave, Team Jedi is proposing or working on a proposal for parental leave. That will have to come before county administration and the labor unions before we can make some sort of decisions about that. But that's just a follow-up on things that were mentioned last month. And other than that, it's just Larry's report.
Larry Workman.
Hey, good morning, everybody. Go through our totals here for the month. We had 806 county staff on the books with 319 election workers, and the Job Training Partnership Act through the youth program, that was 114 folks processed through that. So that's pretty big numbers for them again this month.
Recruitment. Larry, how long does that go, the youth program? Just to the summer?
So they have a summer youth program, but they also have a year-round one as well.
Okay.
Yeah.
So it's probably a higher number in the summer then, right?
Oh, much.
Okay.
Yeah. Through the month, there was 54 new jobs posted, so that's a lot to post. 24 were for county departments, and the 42 were for our schools and municipalities. So schools are gearing up, of course, so there's a lot posted and a lot going on there. As far as the outreach, some more partnership with our Department of Labor, doing some info sessions and assisting with them about civil service issues. Newsletters, of course, put out lots of those. We had a radio ad also that we put out for our deputy sheriff's exam. We had 375 applications come through the month. 212 were for the county, but 163 of those were for our municipal partners. Health program, we now have 133 approved titles through that health program, and 167 people have been appointed through that program. So that's really great, and it's working well. We onboarded 11 new county staff for the month. Out of those 11, 11 of them opted for our health insurance, 10 for our dental, 6 for the vision. And for our leaves, we had 31 folks, or 31 instances for disability. Cancer screening, 12 people took advantage of that, 6 for bereavement, and 1 for jury. Staff trainings, that program is going really well. There were 3. They were interpersonal communication and diffusing strategies. Another one was customer service for public service. And another one was the ripple effect, which had to do with stress management for staff. So that program's doing really well.
So just to add to that, the COVID leave provisions ended in July, so that's where there's nothing on the report for that.
Okay. Questions? Thank you both.
Thank you.
Let's see if we get through some of our resolutions. Our Resolution A is the extension of an additional 1% sales tax for 2 years, increasing taxes on sales and uses of tangible personal property and of certain services and an occupancy of hotel rooms and amusement charges pursuant to Article 29 of the tax law of the state of New York in order to extend the effective date through November 30th, 2027. That's ID 13475. Someone want to move that? Deborah, seconded by Veronica.
And just to clarify, this doesn't increase the tax we're already collecting. This is just to keep it in place.
Well, yeah, we would very much like this not to have to happen every 2 years,
Yeah,
but the state likes to hold our feet to the fire while it makes us spend money for other things. Discussion? Shall we vote? All those in favor? Any opposed? That's unanimous. Resolution B, authorizing the replenishing, here we go, the replenishing of the contingent fund from general fund reserves, ID 13413. Someone want to move that? Veronica, is there a second? Seconded by Deborah. Discussion about this one. Deborah?
Just a question for Corsa, I guess. At our last budget retreat, we learned that our general fund was under the reserve amount. So this is going to take an additional $800,000 out of the general fund?
Yes, it will reduce what we have in the general fund, but remember, this is for 2025, so depending on how we end 2025 will dictate how the fund balance will be by the end of 2025. But yes, so based on the financial numbers that were presented, we have 44 million in unassigned fund balance. So this is taken from that 44 million into the general fund.
Right.
So basically increasing what we appropriated beginning last year to support the 2025 budget.
We just had to spend over $800,000 to pay for the costs that we had incurred to provide for our homeless population. We know it's serious and it's expensive. And we have that on our radar, and our administration is working diligently on that effort and the new shelter issues. And but we simply have to do this. That's why we have fund balance, thank goodness, because things come along that we don't like, but we have to spend the money on. Ready to vote on this one? All in favor? Any opposed? That's unanimous. C is Contingent Fund Appropriation, Department of Planning and Sustainability, 2025 Housing Affordability and Supportive Infrastructure Grant. That's ID 13434. Sean is moving it, seconded by Veronica. Who wants to talk about this one? Deborah?
Well, my understanding from the HED committee meeting where this came up is that this year we have an embarrassment of riches in terms of applications for this HASIG grant. And in order to accommodate all of them, because they're all worthy, the proposal is that we use contingent fund to make up the difference so that we can grant all three.
Corsa?
So I just want to add to that. In previous years, you allocated a specific set of funds to support this process, but we do not have an attached reserve for those allocations. So any fund that were not utilized went back into the unassigned fund balance. So over the last 3-4 years, every year we underspend on that line. So if we had created a reserve for this, we will have sufficient amount to use, but we did not. So this is more of what was not used last year being allowed to be used this year to support the project.
Randy?
Was this moved or was it seconded? I can't remember.
Yeah, it was moved and seconded.
Okay. No, I support this. I know there's numerous, I'm not sure if anybody in my constituents, Newfield or Enfield, have applied for that, but I know they're talking about it, considering it, and they're looking at it. One of the things that they've identified, there are 11 empty homes that have been empty in Newfield and Enfield for many years. And about half of them could be rehabbed and half maybe not. But they don't have funding or the expertise to really identify these things. So, and they're also looking at their mobile home parks as well. There are many, they've got data now on mobile home parks and how many empty pads there are. And there are hundreds of empty pads across the county in mobile home parks. Some usable, some not. So that's the type of things that people are looking at.
Have you talked to INHS about those empty homes?
I have.
Okay.
Shauna.
Yeah, I actually think that there are very few mechanisms that the county has to contribute to affordable housing and actually permanently housing people. And one is through the Community Housing Fund. This grant program is a great program, and I'm glad to hear that people have heard of the program, that they're applying for it. And, you know, I know that we're really finicky, as we should be, to touch our contingent fund, but this is $9,900, and if it could really impact people and put people in homes, I am definitely all for it.
Anyone else? Veronica?
I guess seconding what Shauna said and Deborah, and I just looked up the numbers because we had a more involved discussion about this at HED that Deborah was there for too, and the 3 different projects. I can't remember them all, but also each one was definitely worthy, very promising for helping housing. They were in different municipalities, very different types of projects. And then this history thing that Corsa said, that for this HASIG program, over the years, $110,000 total has been allocated over various funding rounds, but of that, only $40,000 and $140 has actually been spent. So the fact that now we have people asking for more than was allocated is a good problem to have and very worth funding, I think.
Anyone else? Ready to vote? Those in favor? Are there any opposed? That's unanimous. D is authorizing a public hearing on local law C of 2025, a local law adopting the modification of hotel room occupancy tax law. That's 13396. Someone want to move that one? Veronica, is there a second? Leah seconded it. Who wants to talk to us about this and the following resolution, which would be adopting it eventually? Can you tell us about what the modification is that we're asking to happen? I know it has to do with the short-term rentals.
Nick's here, online.
Yeah. Hi,
Hi, Nick.
Mike, I'm not sure, can you all hear me?
Yeah.
Yes, thanks. Welcome.
Great. Yes, thank you. Yeah, this is a update to our hotel room occupancy law to make it consistent with the recently changed state law regarding short-term rentals. So a whole variety of changes have been made that are summarized both in the memo, and then there's a red line markup as well, so you can see those changes side by side. Worked closely with the county attorney's office. Huge thanks to Holly and Maury for their work on this. Basically making sure that we're able to move forward in a way that we'll be able to continue to collect hotel room occupancy tax on short-term rentals. Yeah, happy to answer questions folks have. I know several of you were in the HED meeting last month when this was also discussed.
I think basically you said what there are many changes here, but it's the basic is it's to make it conform with the new state law.
Yeah, we basically have a window here where we can incorporate short-term rentals as a taxable type of unit into our local law without having to go through a corresponding change to the state enabling law. And that is due to the changes in the state law that took place in February.
Questions for Nick? Randy.
Hello, Nick. I did read through this, a lot of changes there. It's a lot there. there was discussion, I brought it up, about increasing the hotel tax from 5 to 6%. Is that dead on the vine, or is there anything going on with that?
I haven't done anything with that. If there's interest in the legislature in pursuing that, we can certainly explore that. That would require a change to the state enabling law as well. So we need to engage our local officials here, Anna Kells, and now of course I'm escaping the name of our senator. Yeah, that would also require a change to our state law.
Right.
Randy, I know you've brought this up several times. I'm sorry, were you finished?
Go ahead.
I just wanted you brought this up several times, and perhaps if you'd like to have it on a budget committee agenda in the future, we should do that for you.
Great, thank you.
Okay, we'll add it to the agenda for next month.
Great, thank you.
How's that? All right, we ready to vote on this one? Scheduling a hearing. All those in favor? Any opposed?
Wait, Maury had a comment.
Yeah, I don't think this affects the vote, but I did want to talk about some other features that are in here, which are much enhanced enforcement provisions, because we do, have a number of entities in the county who basically thumb their nose at the hotel occupancy tax, and I just wanted to point that out as a public service announcement, and also that one of the changes in here in terms of what can or can't be said is that nothing in here would require the county administrator or the county administrator's designees from identifying persons subject to this article who have been found in violation of any of its requirements, which would enable us to establish a wall of shame, so to speak, for those who are not paying attention to the room occupancy tax.
Onondaga County's doing criminal prosecutions against those that aren't paying occupancy taxes. Just
Which county?
something of note.
Which
Criminal, Onondaga. The district attorney has become involved.
Okay, we're ready to vote again? All those in favor? Any opposed? That's unanimous. Now let's go to the actual local law, which is Resolution E, adoption of local law number C of 2025, a local law adopting the modification of Article 11, hotel room tax ID 13395. Someone want to move that? Shauna, Veronica? Any more discussion? Go ahead.
Yeah, I just have 2 points that I think are important whenever we explain this to our constituents. For one, it's whenever people come to visit Ithaca, whenever they stay in a hotel room, they pay a certain tax in order to stay in that hotel room. The hotel actually collects the tax, and they're supposed to pay it directly to the county. Whenever we have people that collect the tax and don't pay it to the county, essentially they're holding our tax money and using it for their own personal need. And so, whenever we talk about criminal charges, I personally don't think that that is too far from where we need to be. And I'm not a punitive person, but I feel like if they're spending tax money that our constituents are going to have to supplement, then, we should be upset and frustrated at these hotels that are doing that, because it's not their money to spend. It's our tax dollars. The other thing is that the reason why we collect this money is because we have nonprofits, we have arts and culture that we actually subsidize more or less from the funds that we receive from hotel tax. And so the more money we receive from our hotels, from the people that visit our county, the more we can provide in these grant programs through STPB and support our local vendors and our local organizations. So, whenever we talk about taxes, I know some people are loving taxes, some people don't love taxes. This is a tax I feel good about because it's taking money from people that are visiting so that we can support our community.
Thank you. Anyone else? Ready to vote? Those in favor? Any opposed? That's unanimous. Our last resolution is a budget adjustment, Department of Social Services, Adoption and Legal Guardianship Incentive Funds, 13414. Someone want to move that? Veronica, seconded by Randy. Who wants to talk about this one? Brittany's here. Do you want to talk to us about this, Brittany? Welcome.
Yeah, sure. Thank you. Hi. So this is funds that we'll be receiving, and they'll cover activities aimed at improving recruitment efforts and increase permanency outcomes through adoption and kinship guardianship. So for reference, kinship care refers to like grandparents, other relatives, and family members who are caring for children. So specifically, these funds will cover activities associated with foster and adoptive parent recruitment, and then recruitment activities and the costs associated with them. And then the funds will also help cover support for kinship foster parents in meeting the approval requirements to pass the health and safety inspections during the certification process. So that could be for like purchasing fire extinguishers, smoke detectors, car seats, sleeping arrangements, etc. So without these funds, the only way to obtain these kind of items would be as an administrative expense or the potential of a foster or kinship guardian to purchase them on their own.
Questions, Deborah?
So I just want to observe that this is budget neutral for us because this is a grant. Yeah, thank you.
Other questions? Ready to vote? Those in favor? Any opposed? That's unanimous. Gosh, you went through them all unanimously. Look at that. Any committee member reports? If not, I'd ask for a resolution to go into executive session for the purpose of discussing collective negotiations pursuant to Article 14 of the Civil Service Law.
A motion?
I need a motion.
Okay.
From Shauna, seconded by Deborah. Those in favor of going to executive session, please raise your hand. Any opposed? Okay. I don't know as we're going to take any I don't think we're going to take any action when we come out. But why don't we wait until they can tell us they've shut down the cameras and things. And who would we like to stay for this? I know Under Sheriff Olin is here, but I think